admission of partner and the revaluation of asset. Can you hear me?
Yes, ma'am.
All right. And before it, let me kindly remind about the test. You are writing your test 2 on 2nd of May next week. So kindly prepare for it. As I said, the coverage for the test is um, the accounting for non-profit making organization and the partnership accounting and up to the admission of partner, up to that part. Revaluation of accounting will not be uh, in the test 2. Can you see the slide? Word document? Is it Word
Yes.
document seen? Okay.
Yes.
I just would like to know that, guys, you are planning to go somewhere over this Labor Day holidays, or you most of you are, will be just around? Are you be just around, or you are planning to travel? Just tell you about yourself.
I'll be around, ma'am.
Okay.
Me too.
Okay. So I'm just thinking maybe on Saturday or Sunday. If you guys think you need a session, even on no, not Monday. Monday I'm busy. Saturday, Sunday, if you want, I can conduct 1 hour online class just to clear your doubts. If you have any doubts, I can clear your doubts. But you have to suggest me on the WhatsApp group, okay? Otherwise, in terms of covering the syllabus, we are fine. Next week, I will able to finish the syllabus. Okay, so yesterday we did some exercise in terms of recording the business transaction on the admission of new partner. There is another exercise you can see on the screen. Nia and Gia are partners sharing profit and loss in the ratio of 2:1. They admit Sia as a new partner for 1/4 share in the profit. Sia pays 50,000 as capital but does not bring any amount for goodwill. The goodwill of the new firm is valued at 36,000. On the basis of it, you have to give or pass the journal entries in the books of account. So here is another scenario where the new partner, he bring the capital but does not bring the amount of goodwill. Okay. So in that situation, how we are going to record in the books of account, and what changes will come in the balance sheet or statement of financial position. So as it says, so the first two partner, Nia and Gia, they are already in the business. The new partner, Sia, joined the business and he bring the capital. So that is the new changes come. We need to record the amount of capital which is bring in the business, 50,000 pula. So this amount came as a cash or into the bank. That's why this is the format of journal entries. We have the date column, particular column, ledger folio, in which ledger this transaction is going to be transferred. Ledger books, T accounts. So from here we transfer to the ledger account which is called ledger folios, in which file they are going to be transferred and which amount has to be debited and which amount has to be credited. Like this we record. So the new partners here bring the capital either as a cash or bank. Both are correct. Either if you write cash account debit and write the amount in debit column, amount column, or if you write bank account debit and write the amount, because it's not indicated the capital has been paid as a cash or in the business bank account. So you can use anyway. Cash account debit with 50,000 to CR's capital account, being the amount of goodwill and capital brought by the new partner. It's just only capital, not goodwill. Capital brought in by the new partner. So you make first entry, then they also valued the goodwill of the new firm from the old asset, 36,000. So we have to find out what is the old ratio and the new ratio, and then this 36,000 is going to be apportioned among the partner. Then CS capital account, from this how much share amount is going to be shared between the old partners, Nia and Gia. So the amount of new partner shares of goodwill transferred to old partners to capital account. So he didn't bring something as a separately. He just bring the capital, and then from that capital, we will calculate the amount of goodwill. So as nothing is given about sacrifice ratios except the old ratio and the new partner sharing ratio. So we just calculate. Normally when the new ratios are given for all partners, we calculate the sacrificing ratio, old ratio minus new ratio. But in this exercise, you are only given the old ratio and the ratio for new partner. So we can say that the sacrificing ratio is equal to the old ratio, 2:1, and the goodwill of the firm is 36,000. So 36,000, and in this 36,000, the new partner Sia who joined the business, his proportion is 1/4. He's sharing the profit 1/4. That's what the partner agreed. So he will also get the share in the goodwill, 1/4 of the new firm goodwill that they valued. So the new firm goodwill is 36,000. So 1/4 of 36,000 is equals to the 9,000. It means the share of in the goodwill of the new partner is 9,000. Now this 9,000 will be apportioned or shared by the old partners in which ratio? In their sacrificing ratio. So how we calculate? We just calculate. You remember when the new ratios are not given there, then how we calculate? Suppose the total profit is 1 and the new partner portion is 1/4. 1/4. So what is the remaining portion for other two partner? Is when you solve it, it become 4 minus 1/4, because you have to make the same denominator. Then it means 3/4 is the proportion for old partner in the profit sharing ratio, because we don't know how much they are sacrificing. So we calculate like this. If the total profit is 1 and the portion of new partner 1/4, so 3/4 is the portion of old partner. 3/4. Now you have to find out how much they're sacrificing in the old. Then we calculate like this. If you remember, one of the slides shows that. I'm just showing. The old ratio was 1:2. 1:2 means 2/3. Then how much times 3? Then how much it is in 3/4? Same thing, we will calculate for the, so to make same denominator, 3 times 4, 12. So it become 8 minus 9 and divided by 12, which is give you the ratio for partner Nia. Or you no need to do that, because if you know that their proportion is 3:4, then 3:4 you can change how it is according to the 1:2. So that's how you can calculate. And then this portion 9,000 you can divide it in the ratio of old narration 2:1. So 9,000 times 2 divided by 3. So the Nia, he will get 6,000, and the Shia's capital, his portion, is 9,000, which is his goodwill, and that goodwill share to the old partner with their old ratio 2:1. The 3/4 portion will share like this. So that's how we make the entries in the books of account. Do you understand this part?
Yes, ma'am.
And 3/4 is become like this because the Cia also have 1. So 1:2 ratio is for Nia, 1 for Gia, and 1 for Cia. So the total 2 plus 1 plus 1, 4. So 3, among 3, 2 is for the Nia, 1 for the Gia, and 1 for the Cia. That's why the total is 4. So the new profit sharing ratios become 2:1:1. And the 9,000, the share of the goodwill of the new partner will apportion to the transfer to the old partner's capital account. Then if you ask to prepare the balance sheet for this business, if you are also given the value of asset, as he bring the capital in a form of cash, so the current asset cash will change, cash amount is changed, and also where is that question? Yeah. So when you're preparing the goodwill for the new firm, there's no match in the, you just start with the intangible asset, how much goodwill in the business, then current and non-current asset, then the changes in the cash, same liability, what is given there, unless there is any information about changes in liability. And this is the main part, the capital. Because when you are showing the capital, you have to show the capital, updated capital, including the amount of goodwill to each partner. And this value of net asset should be equal to the total value of finance by as capital. Then that is the only change comes when a partner admit in an account partnership firm. That is the change only come in the balance sheet if you ask to prepare a balance sheet for the new partnership firm. Are we together?
Yes.
Okay. Now let's see some other activity. So I put some activity in terms of recording the amount of premium of goodwill, sharing of goodwill from new partner to the other partner. You can go through all these examples. Okay. Sometimes in the partnership firm, the businesses also need to do the revaluation of partnership asset. The revaluation. Do you know what is the purpose of revaluation of asset in the partnership, or why the partners need to reevaluate their asset? Normally, the revaluation is done when the business has to sell, or business has to sell to someone. When someone wants to sell his business, then they do the valuation of their asset so that they can determine the selling price. But sometimes in the partnership, the business also do the revaluation of their asset even when they are not selling their business to anyone, but still they do the revaluation to find out the current value of their assets and liabilities in the business. So do you know that when the partnership business is not selling, then what are the other reasons to do the valuation of the asset in the partnership business? Anyone? Apart from selling the business, there are some other reasons when the business do the revaluation of their asset, especially in partnership. There are certain conditions when the revaluation is required. Number one, if a new partner is admitting in the business, like in the previous, we have seen that there is no changes in the assets and liabilities and other expenses in previous example. But sometimes when the new partner coming, there is also some changes in terms of the value of asset and liabilities. The another reason the business need to do the revaluation of their asset when a partner leave the firm. Maybe at the beginning there are 5 partners who running a business, but due to some reason or health issues, a partner would like to leave the business because he is no longer capable to participate in business activity. So when the partner leaving the business, that time also they need to do the revaluation of their asset and give the portion of retiring partner or leaving partner, and the rest of asset has been in terms of capital stated and shared in the books of account. And the third reason of revaluation of partnership asset is when the partner change profit and loss sharing ratio. because it's also possible at the beginning they agreed on certain ratios, maybe like 5 is to 3 is to 2, but later on they realize that the partner who is getting the major portion not really contributing that much work in the business, and the partner who is getting less portion of the profit take more part in most of activities of the business. So when their responsibility change or recognize, they also would like to revise the profit and loss sharing ratio. Like currently in this business ABC, they are sharing the profit and loss in a ratio of through 2 is to 3 is to 5, but now they would like to change to make it 3 is to 3 is to 4. So when they are changing, as the proportion change, they also need to do the revaluation of partnership asset. And if there is any gain or loss on the revaluation of asset, that gain and loss also need to be recorded in the books of account. If they have any loss, sometimes it's possible they might be have the loss, or they maybe have profit. So if there is any profit or gain or loss, they have to reflect in the books of account. If the revaluation shows no difference in asset value, sometimes it's possible maybe there is no change in the value, so no further action is required. We no need to make any changes in our books of account. This will not happen very often, especially if assets include like building, because they are normally shown at the cost less depreciated value. So that's why the revaluation done. And when we do the revaluation, we have to prepare an account. That account is called revaluation account, in which we shows any changes which has happened in that year in the business. So how to prepare a revaluation account? What's the form of it? It is also prepared in a form of T account. One side, the gain or the values increase, and another side, the value decrease. So with the help of this example, we are going to learn how to do the revaluation of asset when it is required in the partnership. Okay. So this is an exercise about a partnership where they have 3 partners. A, B, and C are partners sharing profit, and in the ratio of 2 is to 3 is to 5. On 31st March 2020, their balance sheet was as follows. So they have the assets, cash, accounts receivable, furniture, furniture with the value of 28,000, closing inventory 44,000, debtors 42,000, investors 32,000, machinery for 34,000, and the goodwill they valued 20,000. And these are the proportion of their capital. They also have creditors, accounts payable, for 32,000, and there was a profit and loss transferred from the income statement 14,000. So that was the balance sheet for their business. Now you have also provided other information of the admitting a new partner D. They admit D into partnership on the following terms: furnitures and machinery to be depreciated by 50%. The stock is revaluated at 48,000. Goodwill to be revaluated at 24,000. Outstanding rent amount was 1,800. Prepaid salaries it's 800. D to being Pula 32,000 towards his capital for 1/6 portion of the 1/6 share in profit and loss ratio. So on the basis of it, you are required to prepare the revaluation account, partner's capital account, and the balance sheet of the new firm. Okay, do you understand the question? When they admit the new partner, the following changes when the revaluation was done, the following changes or is done shown for the individual assets like furniture stock was do the revaluated at 48,000. Are we together? Or you want to go through again with the question? Hello?
Let's continue.
Okay. Just check the figures so that you can understand the calculation. So we start with preparing the revaluation account, where one side we account the changes in the assets, increase or decrease, and other side the expenses, which is not yet done, so that we can find out if there is any profit or loss in the business. So the first thing they said, okay, depreciation with charge, the stock was revaluate because previously in the balance sheet they shows the value of a stock is 44,000, but when they do the revaluation they found not actually the value of a stock is for 48,000. So how much it is increased by? Previously it was valued 44, right? So it is increased by 4,000. Goodwill was indicated 20,000, but when the revaluation was done, it was valued at 24,000. So the stock was valued for 4,000, and then there was prepaid salaries, because if it is prepaid, we also take it back recorded as a cash in the revaluation account. Then the furnitures and the machinery was depreciated by 15%. So what is the value of furnitures and machinery? Furniture and machinery was depreciated by 15%. The furniture was for 28,000 and the machinery was 34,000. So 15% of 28,000 is how much?
4,200.
4,200. And on the machinery, 34,000, 15% depreciation. Yes, 5,100, 15% on 34,000.
Yes.
Okay. So we calculate the depreciation on furnitures and machinery, and there was also outstanding rent. These are the expenses. So the total amount spent, uh, which is not previously there in the previous income statement and balance sheet, for 11,100. and they were received 4,000 by revaluation of stock and prepaid salary. So they have the deficit balance of 6,300. How we get 6,300? 11,100 minus 100 minus 4,800. So the remaining amount is 6,300. This 6,300 has to be a portion between the three partners uh, according to their profit and loss sharing ratio, 2 is to 10, 3 is to 10, and 5 is to 10. So each partner has the loss portion, because when you increase, when you are doing the revaluation, when the value appreciate is more than your expenditure, it will show the profit or gain on the revaluation. But when your expenditures are more than your increase, it will show the loss on the revaluation. Are we together? And that loss has to be shown among the partners, right? Now,
Yes.
after the evaluation, then we need to prepare the partner's capital account. In partner's capital account, uh, we record the how much proportion each partner has in the business. So capital in capital account is always recorded in a credit side. That's why here is also shown in a credit side. So the balance we get 36,044.52 from the old balance sheet. Okay, so the balance come for partner A, B, and C. And there was at the previously there was no partner D. He just recently joined, so there was no balance carry forward for the partner D. Okay, then. Um, Then we transfer the loss on revaluation, the amount which is deducting, we are deducting from the capital. The loss, you will write this out. The proportion of A for A in loss is 1,260, for B 1,890, and for C 3,150. Then in the balance sheet, they shows from the income statement, the profit and loss. The profit was transferred is 14,000 for the business. Now this 14,000 has to be apportioned among the three partners according to their profit and loss sharing ratio. So what is their profit and loss sharing ratio? 2 is to 3 is to 5. So 14,000 will be a portion in 2 is to 3 is to 5. So you can make a calculation. 14,000 times 2, 2 plus 3 plus 5 means 10 divided by 10. So the A in profit and loss, the share of the A is 2,800. The share for the B, 14,000 times 3 over 10. So the portion for the B is 4,200 and portion for the C is 7,000. 14,000 times 5 divided by 10. Right? That's how we calculate. Are we together? So first in capital account, we write and the balance of capital shown in the balance sheet from the previous year. So balance brought down, then sharing of profit and loss, and this capital. Okay, here the loss on revaluation, then the goodwill. Okay, how the goodwill has been calculated. How much goodwill given in the question? The goodwill in the old balance sheet was given 20,000, right? Can you see? The goodwill was given 20,000. Then after joining the new partner, now it's become 24,000. So we will do the separate for them. So the goodwill was 20,000. 20,000 goodwill is always a portion according to the profit sharing ratio. 2:3:5. So the 2 over 10 of 20,000, which is 4,000, will go to the A. For B, 6,000. For C, 10,000. Okay.
Yes, ma'am.
Then by cash, either you can write before or last, because the new partner C, partner D, when he joined the business, he brought 32,000 into the business. So this 32,000 cash comes into the D, and then the another 4,000 goodwill, the goodwill which is increased when the new partner joined on the revaluation of goodwill, that 4,000 will also apportion uh, among the uh, this ABC in a ratio of 2:3:5. So 2,000 times 2 over 10, 800 will go A, B from the, and this will be transferred to the D account. 8, 100 and 2,000 is taken from the D and apportioned to the old partners. We always apportion the new partners' goodwill to the old partners. So from D's account, A, B, C, A to A's goes 800, for B it goes 1,200, and for C it goes 2,000. So, and D is reduced by 800, 1,200 and 2,000, because from this that goodwill has been paid to the ABC. Then we find out the total of A account, the total of B account, and C and D. Then this side you also need to calculate the total of A, the credit side total. This is the credit side. The credit side total is 39,600, and the debit side total is 5,260. So credit side total is more than the debit side. That's why the balance carry down will calculate here. So from 39,600 we subtract 5,260. So the balance left 34,340. Same we will do for the B. The total of credit side of the capital account of B is 49,400. From there, we subtract the total of debit side, which is 6 plus 1, 7,890. So the balance you will get 41,510. Same for the D, C, and then for the D is 32,000. From this, we paid 4,000. So the capital of the D at the end of the year is left as a 28,000. So this balance will become the opening balance for the next year. This is the closing balance. This is the opening balance which is come from the previous year. Are we together? So that's how we prepare the partner's capital account. And then what else we need to prepare? We also need to prepare the balance sheet of the new firm. This balance sheet has been prepared in horizontal form, but we can also prepare in vertical. So the cash The cash account shows 50,000. Accounts receivable, it was now is 24,000. Okay, it was 24,000 previously also. Furniture, it is let's see the furniture, how much in the old balance sheet. Furniture was for 28,000, right? Now, and the cash was 18,000. Then the new partner, he bring 32,000 towards to the business as his capital. So he bring 32,000 cash. So 32 plus 18 become cash 50,000 in the new balance sheet. You understand how it's become 50? That's how it's become 50. Account receivable, there's no change. 23,000. Furniture, stock 48,000 because when it's revalued it is 48,000. And debtors 42,000. Investment 32. Prepaid salary 800. And the creditors for 18,000. There was no change. And this balance will come from the partner's capital account. The balance of the capital is 34,400 and 28,000. What is this? To creditor. Then let me check. Why did I write 2 times? Creditors for 64,000. What is this amount? It can be creditors. Outstanding rent we taken, creditors we taken, account payable. What is the total of it? Just give me a minute. 151, 700. Okay. No, this is not. It's a mistake. Yeah, I start with capital creditor. The total of it is already 249, 249,500 pula. The sum of it, if you check, is there's nothing 18,000 any figure. So that's how we prepare the balance sheet for the new business. Okay. So far we done the revaluation account, partners capital account, and the balance sheet. Is there any question on this part?
Okay.
I will also prepare this balance sheet in vertical form so that you can understand in vertical form also before I upload these notes on the Teams and on WhatsApp group. Is any question on this exercise? Okay, can you please take a picture of this question, the next question? Try to do yourself. Take a picture of this question. Did you take?
Yes, ma'am.
Let me show the down part as well. Yeah, up to here. So attempt this exercise, then we will discuss the solution so that you can check if you understand how to do the revaluation of assets in the partnership business. Okay, so wherever you did not understand when you attempt this one, we will discuss in our next class. Thank you. Okay, anything would you like to ask before we close our meeting?
Ma'am, may you please post the tutorial for this week?